In this module, we're going to discuss ECOA. ECOA is the Equal Credit Opportunities Act. It's also known as Regulation B. To remember that it's Regulation B, I like to say that the creditors, the lenders, they must be equal when extending credit, meaning they can't discriminate. There can't be different terms because one person may be male and the other female, or another person may be a Latino while the other is Asian. No, they have to be equal when extending credit. ECOA is all about the rules and regulations regarding credit applications when someone applies for credit. Doesn't matter whether it's a credit for a house, car, boat. ECOA is about credit and credit application. So here we go. This law or act was signed by Congress back in 1974, and the whole purpose of it was to eliminate discriminatory treatment in credit application. Primary reason why ECOA was enacted in the first place was because of the evidence that women were not treated on an equal basis with men when applying for credit, including applications for mortgages. So that's what brought this all about, ECOA. Today, ECOA and its regulations are intended to promote the availability of credit to all credit-worthy applicants, regardless of their race, color, religion, national origin, sex, marital status, and age. It doesn't matter. Everyone should have an equal chance to obtain credit. ECOA is a federal law that ensures that all consumers are given an equal chance to obtain credit. And I know this is a mortgage class in MLS, but we're not just talking about mortgages. We're talking about credit for anything. It could be a jewelry store, a car, a motorhome, a credit card. The whole purpose of ECOA is to provide everyone with an equal chance to obtain credit. What type of loans are covered by ECOA? ECOA applies to transactions for the extension of credit by any person who regularly extends, renews, or continues credit. The law also applies to a person who regularly refers applicants to creditors, or selects or offers or selects creditors to whom requests for credit can be made. Mortgage brokers serve primarily as a liaison, an in-between person between the borrowers and the lenders, referring applicants to select lenders, or by offering borrowers a variety of loan products. That means that the ECOA rules and regulations apply to you as well. Therefore, the definition of a creditor applies to a mortgage broker and is not limited to lenders, mortgage bankers who actually extend credit. ECOA has 8 protected classes. A protected class is a class of individuals, a status that the creditor cannot count on this or use this as the reason to deny or approve us. So ECOA has 8 protected classes. The first one is sex. You cannot be approved or disapproved based on whether or not you're male or female. They can't say things like, we don't give loans to females. Race, they cannot deny you based on your race. Okay, so they can't say, well, we don't provide loans to Caucasians or African Americans or Asians. That's a protected class. Color, national origin, where you're coming from, what country, religion. They can't say, oh, we don't give loans to Catholics or we don't give loans to Muslims. Those are protected classes. That can't be the reason why they're not giving you the loan. Age. You just have to make sure the borrower is at least 18, or if they're applying for a reverse mortgage, that they're at least 62. Other than that, you can't use age, or a creditor can't use age as a reason to deny or approve someone. You can't say, hey, well, no, this is a Maserati and you're 92. We don't feel comfortable giving you a loan on this Maserati because you're 92. They can't use your age as the reason why they're denying you. That's a protected class. Marital status is another one. And receipt of public assistance. So you have to make sure you really understand what public assistance is. Public assistance is any non-taxable income. They cannot deny you based on your receipt of public assistance. Here's some examples of what's considered public assistance. Welfare, Social Security, disability, child support, alimony. There's tons of others. I can think of pension, retirement income, foster care income. They cannot deny you. They can't say things like, your income is only Social Security and we don't take Social Security. They can't do that. That's a protected class. Or all you get is child support, and we don't want to approve you based on child support. They can't do that. What if you have like 6 baby daddies and you have tons of child support coming from each of them? They can't say the reason that they're denying you is because of your receipt of child support. That's a protected class that comes under public assistance. So this is what I want you to remember here. They cannot deny you based on your source of income, meaning where it's coming from. However, you can be denied based on your amount of income. That's a totally different thing. For example, we're not denying you because you get Social Security, but we're denying you because the $900 a month you get for Social Security is not enough to qualify for this Maserati. We're not denying you because your income is child support, but the amount that you get doesn't qualify you for this $600,000 house. They cannot deny you based on the source of the income. However, you can be denied based on the amount of income. Now, ECOA has special specifications that you need to be aware of when it comes to marital status. According to ECOA, that loan originators cannot ask applicant if he or she is single, divorced, or widowed. Those are words that you cannot use. You cannot say, are you single, widowed, or divorced? The only 3 choices on the application regarding marital status is, are you married, unmarried, or separated? So that's how you have to ask that question. You have to say, are you married, unmarried, or separated? If not, you're violating ECOA. You're violating Regulation B. Unmarried refers to persons who are single, divorced, or widowed. These are the only 3 terms that creditors, including you, are allowed to use when making inquiries related to marital status under ECOA. Use of information concerning marital status, except as otherwise permitted or required by law, a creditor shall evaluate a married and unmarried applicant by the same standards. And in evaluating joint applications, a creditor shall not treat applicants differently based on the existence, absence, or likelihood of marital relationship between the parties. So if 2 people are on the loan together, but they're not married, you can't discriminate against that. That shouldn't make a difference in their credit application in a joint application. As it relates to age, a creditor cannot consider the age of an applicant under these circumstances. The applicant is too young to sign a contract. Generally under the age of 18, or the applicant is applying for a reverse mortgage, they have to be at least 62. Other than that, age cannot play a factor in the decision as to whether or not a person is going to be approved for a credit application. The creditor just has to make sure the borrower is at least 18, or if they're applying for a reverse mortgage, that they're at least 62. You can't say things like, well, you're 21, but this home is 6 bedrooms. We think that's too much responsibility for a 21-year-old, and that's why we're denying the loan. If they're at least 18, they can apply for the loan. And they can't be too old. Well, like an example I gave earlier, you're 92 and this is a Maserati. We think you're too old for that. You can't make that decision. You can only consider if they're at least 18, or if they're applying for a reverse mortgage, that they're at least 62, and that's the end of your evaluation regarding their age. And you can only ask questions to determine, is that their situation? Are you at least 18? Are you at least 62 if they're applying for a reverse mortgage? And then you have to move on from that. So now we're going to talk about certain notifications that are required under ECOA. There are several different times where the creditor must give out certain notifications or disclosures. Regulation B requires specific requirements for creditors regarding notice of action taken, ECOA notices, and they have to give certain reasons for why they're doing certain things to their applicants. So we're going to go through the various different notifications that are required under ECOA. When a person applies for credit, the creditor has 30 days to give them an answer on a credit application, whatever that answer is. But the point is, when you apply for credit, you should be sitting around like, did I get it? Did I get it? Did I get it? No, the creditor has 30 days to let you know the answer. So a creditor shall notify an applicant of an action taken within 30 days after receiving a completed application, whether or not you're approved, or give you a counteroffer, or maybe your application was incomplete, or what they call an adverse action notice. An adverse action notice is just a fancy word for a denial letter. But whatever their decision is, whether you're approved, denied, which is an adverse action notice, your application isn't complete, or give you a counteroffer, how long does a creditor have to give you an answer on a credit application? 30 days. Notice of adverse action. I just explained to you that adverse action is just a fancy word for no, you didn't get it. It's a denial letter. Well, if they give you an adverse action notice, there's certain criteria that notice has to meet. If the creditor takes adverse action, meaning a denial, on the application, the notice must provide the statement of reason why they're denying it. And it must include a statement that ECOA prohibits discrimination against credit. See, the first statement that you're going to get, they have to give you within 30 days, is just going to be a generic denial letter. We got your application, and based on what we see, your application has been denied. Okay, they're not going to go into specifics, but they do have to let you know the status within 30 days. The notification must be in writing. It must contain information, including the name, address of the creditor, and the nature of the action taken. So they're going to give you some basic information that your application was denied, and they'll give you the name, address, and phone number of the credit reporting agency that they use to make that decision. If there is more than one applicant on the application, where there's more than one applicant for a mortgage loan, the notice is only required to be given to that one individual, the main person. Where there is an apparent primary applicant, if there's more than one person on the application, because sometimes there's 2 or 3 people, maybe even 4, the notice of action is only going to go to the primary applicant. If the application is complete, there's what's called a notice of incomplete application. They still have to give it to the borrower within 30 days to let them know that their application is incomplete. But that notice of incompleteness must contain certain information. For example, what information is needed? Set a reasonable time frame that the borrower has to submit that information, and advise the applicant if they fail to provide that information, they're not going to be considered for the loan. So they have 30 days to give you this notice or give this to the consumer, but on that notice, they have to tell them what information is needed. They have to give them a new deadline, and it has to inform them in writing that if you don't get it to us by this deadline, then your application is not being considered at this point anymore. When it comes to the appraisal, there's certain rights as well, and ECOA specifically has certain things you need to know as it relates to the appraisal. And a lot of people wonder what the appraisal has to do with ECOA, but ECOA is the law that requires that the borrower in a mortgage loan get a copy of the appraisal. So there's certain rights under ECOA as it relates to the appraisal. A borrower under ECOA must receive a notice of right to receive a copy of the appraisal within 3 days of the application. When a person applies for a mortgage loan, ECOA says that the lender must give them a notice informing them that they have the right to receive a copy of their appraisal within 3 days of the application. They're not receiving the appraisal, they're just receiving a letter letting them know that they have a right to get a copy of it once the appraisal is completed in this mortgage transaction. If an applicant is denied based on the appraisal, the consumer has the right to request the appraisal report within 90 days, and the lender must provide it within 30 days. That's just the rule. Now, it's not just if the application is denied. If the application is denied based on the appraisal, the borrower has 90 days to request a copy of the appraisal, and once that lender gets that request, they have 30 days to deliver it. If the application was not denied, maybe the application was approved, when does the borrower get a copy of the appraisal? They get a copy of the appraisal no later than 3 business days before the loan closes. So if the application was approved, the borrower will get a copy of the appraisal at least 3 days prior to loan consummation to doc signing in order to review it. A copy of all appraisals are due promptly after they are completed, or at least 3 days prior to loan consummation, whichever is earlier. A borrower may waive the timing requirement as long as they still receive a copy of the appraisal prior to loan consummation. And if the creditor denies the loan application or the application is withdrawn by the consumer, the obligation to provide a copy of valuation still exists. The lender still has to provide that. However, the only difference is the deadline of the 30-day extension after the date won't apply. They still have to give it, but they don't have to do it within 30 days. But they still have to give it to them. ECOA also deals with limitations on the disclosure of income from alimony, child support, or what's considered separate maintenance agreement. Alimony and child support are the only type of income that the lender cannot require that a borrower disclose. They cannot make a borrower use their child support or alimony. However, if the borrower does want to use their child support or alimony to qualify for a loan, the lender must accept it. What law says the lender must accept it? ECOA Regulation B. So although child support and alimony are optional, whether or not the borrower wants to use them as a source of income, if they do, what law says the lender must accept it? ECOA Regulation B. But here's the general rule. A creditor should not inquire whether an income in an application is derived from alimony, child support, or separate maintenance payments if the applicant does not want the creditor to consider it in determining their credit worthiness. You cannot ask them, do you receive child support? Do you receive alimony? Do you receive a maintenance agreement? But if they want to volunteer that information, then they can. The only thing you can ask are things like, are there any other sources of income that you'd like for me to consider? And if there is, they'll let you know. Now, I'm always asked, well, why wouldn't they want to use that income? Or why would they? And this is my scenario. Sometimes a borrower, the underwriter looks at the bank statements and they see income coming in, like $500. And they say, well, what is this? And the borrower say, well, that's my child support or my alimony. And then the underwriter says, well, we need proof of that. We need to put that on the loan. The borrower can decide, I choose not to. I don't want to use my child support or alimony to qualify for this loan. That's their right. But then you have some situations where the borrower may be coming in $200-300 short of meeting certain ratios to qualify for a loan. That's where they may say, hey, but I have child support, I have alimony, I can give you proof of that. So those are two examples of when they may want to use it or when they may not want to use it. But my point is, if a borrower wants to use their child support or alimony, ECOA Regulation B is the law that says that the lender must accept it. However, it also says if they don't want to use it, they don't have to. Another thing that people get confused as to why this comes under ECOA. It's about childbearing and child rearing. And yes, this is under ECOA. Limitations on requests for information concerning childbearing or child rearing. This comes under ECOA. And this is what it says. A creditor should not inquire about birth control practices, intentions concerning bearing or rearing children, or the capability to bear children. Why do they need to know that under ECOA anyway? But you need to know that ECOA says they can't ask questions about or concerning child rearing Are you going to have any more kids? Things of that nature. They can't ask that on a credit application. A creditor may inquire about the number and ages of the applicant's dependents or about their dependent-related financial obligations, provided such information is requested without regard to sex, marital status, or other prohibited practice. But what law says the lender or the creditor cannot ask a borrower about their birth control methods, childbearing methods, child rearing methods? Are you planning on having any more? That comes under ECOA. Sometimes you have two laws that are really close and they overlap, such in the case of ECOA and HMDA. So we want to make sure you know the difference between ECOA and HMDA and what's specifically required under HMDA versus ECOA. HMDA is the Home Mortgage Disclosure Act, and it's a federal law that was enacted for the whole goal. It was to discourage what's calling redlining. Redlining is discriminatory practice that lenders use to prevent giving loans in certain neighborhoods. So the whole purpose of HMDA, which is Regulation C, is to identify possible discriminatory acts. And it's the law that led to the reason why we have redlining. And redlining is refusal of lenders to make loans in certain neighborhoods for discriminatory reasons. So there are some things that ECOA and HMDA have in place, and I just want to make sure that you guys know the difference and know what's required under ECOA, what's required under HMDA, and how they can be commingled. HMDA accomplishes this by monitoring the mortgage lending practices of banks, depository and non-depository. The data about loan applicants is collected, and that data is used to determine whether the banks are sufficiently meeting the borrower's needs in that particular community and where they're located. The first step of the process, however, involves inquiries on the loan originator regarding the personal characteristics of the credit applicant. Therefore, in every creditor's credit are obligated to request information regarding the applicant's ethnicity, race, sex, marital status, and age. If you look on a loan application in 1003, there's going to be questions on there regarding monitoring these particular things. They're going to ask about, it's section 10 of the 1003, they're going to ask about an applicant's ethnicity, their race, their sex, their marital status, and it also asks about their age on a loan application as well. ECOA requires creditors, meaning us as well as mortgage loan originators, to explain to consumers that this is a request from the federal government in order to monitor compliance with anti-discriminatory laws. It's not just our office or our location or that bank that wants to know that information. ECOA says that we have to let them know the reason. Because, see, the bar has the right not to provide it, but we have the authority to, not so much the authority to, we have the obligation, I should say, to inform them as to why this information is being collected. So ECOA requires creditors to explain to consumers that this is a request from the federal government in order to monitor compliance with anti-discriminatory laws. The creditor must inform the applicant that they are required to provide this information on the basis of visual observation or surname if the applicant does not wish to provide it themselves. What does that mean? Well, we have to let them know. You can't just do it. You have to let them know. You have to inform the applicant that if they refuse to complete section 10 of the 1003, if they refuse to complete that section, you have to let them know that it's still going to be completed, but it's going to be based on visual observation or surname, meaning their last name, if the applicant does not wish to provide that information. Lender has to fill out reports. These reports are called loan activity reports, and they have to track how many male, how many female, and the different ethnicities. So if the bar doesn't complete that section, and you've seen it, it's the last part of the loan application section 10. If the bar doesn't complete it, which they have the right not to complete it, What happens is the mortgage loan originator is supposed to complete it. And we're supposed to complete it based on observation. And if we don't complete it, then the lender is going to complete it based on surname, based on their last name. They're going to say they have a algorithm in their office that say last name Nguyen, maybe that's Asian. Last name Smith, maybe that's Caucasian. Last name, we don't know. But the point is, if the borrower does not complete it, which they have the right not to, then ECOA says if the application is taken face-to-face, it should be completed by the mortgage loan originator based on observation. And if we don't do it, and in my office we don't, we just send it in and we let the lender complete it, because then they will just complete it based on surname. But the point here is, what law says that you have to let them know that that's how it's going to be done? ECOA says you have to do that. And if the application is being made over the phone, the creditor must request this information and also give them that particular explanation as to why they're asking that information. And they still don't have to give it, but you have to at least tell them that you're collecting it because it's a requirement of the federal government to try to monitor anti-discrimination laws. As far as ECOA enforcement, ECOA records are kept for 25 months. The reason being is a person has up to 24 months to sue under ECOA, so the records will still be there. So ECOA records are kept for 25 months because a civil action, a lawsuit, can be filed up to 2 years, 24 months. So in case a person waited to the last minute to file that they've been discriminated under ECOA, if they waited to the 24th month, the records are still there because the records are kept for 25 months, and the general penalty for violating ECOA is $10,000 per violation. This training session, we're going to talk about the Fair Housing Act. So there are two laws that deal with discrimination. We talked about ECOA, which deals with the discrimination in a credit application, and now we're on Fair Housing Act. Fair Housing Act is also about discrimination, but it's about discrimination in the sale and lease of property. It started with the Civil Rights Act of 1968, and now it's more commonly referred to as the Fair Housing Act. The Fair Housing Act deals with discrimination in the sale and lease of residential property. Remember, residential property simply means 1 to 4 unit property, owner occupied. So the Fair Housing Act has 7 protected classes. The first 5, the ones I have in the black, sex, race, color, national origin, and religion, are also protected by ECOA. So circle those and make yourself a note that sex, race, national origin, color, and religion are protected by both ECOA and fair housing. But the 2 that I have down here in the red are only protected under the Fair Housing Act. Physical or mental disability. So what the Fair Housing Act is saying is, you can't refuse to sell or lease me a property based on my sex, my race, my religion, my national origin, my color, but also you can't refuse to rent me or sell me a place because I have a disability. Maybe I'm in a wheelchair, or maybe I just have one arm, or maybe I have a hearing aid. They cannot, meaning those that are selling property and leasing or renting properties, refuse to discriminate or refuse to rent or sell you a property because you have a physical or mental disability. That will be a violation of the Fair Housing Act. Also, familial status. You need to know that familial status includes families with children under the age of 18. So they can't refuse to rent or sell to someone because they have kids, or because the person is pregnant or something of that nature. Familiar status just means anything having to do with children. The question that you'll most likely see in the discussion questions that we have coming up is, what law did the company violate when they refused to lease her a property or rent to her a property because they said she was 6 months pregnant and the property was on the third floor? Well, they violated her Fair Housing Right Act under the familiar status. You cannot refuse to rent or lease something to someone because they're pregnant. That will be a violation of the Fair Housing Act. Now take a look at this chart. You have to know what's protected by both ECOA and fair housing, what's only protected class under ECOA, and what's only a protected class under fair housing. So I made this chart for you here. And you'll notice those in the blue: sex, race, religion, national origin, color, are all protected by both ECOA and fair housing. A creditor cannot discriminate on providing you credit based on these. A person that's selling or leasing a property cannot refuse to sell or lease you the property based on these protected classes. But ECOA has 3 additional protected classes: age, marital status, and receipt of public assistance. Cannot deny you credit because of your age, cannot deny you credit because of your marital status, cannot deny you credit because you receive public assistance. Remember, public assistance does not just mean welfare. Social Security, disability, child support, alimony, workers' comp, student loan, any income that you get that is non-taxable is considered public assistance. Fair housing, they cannot also refuse to sell or lease you a property based on disability or handicap or familiar status. Remember, familiar status means anything having to do with children. So my point is, make sure you understand what's protected by ECOA, what's protected by fair housing, which protected classes they share. These I have in the blue: sex, race, religion, color, national origin. What's only under ECOA: age, marital status, receipt of public assistance. And what's only under fair housing: disability and familiar status. This section, I'm going to talk about some Fair Housing Act exemptions. When is a person exempt under the Fair Housing Act? So there's some times when it's okay to be discriminatory as it relates to the Fair Housing Act. These are called Fair Housing Act exemptions. It is not a violation to refuse or rent a room to someone in your own house. That's an exemption. If you are renting a room in your own house, you can be discriminatory. You don't have to rent it to every sex, race, color, creed, religion, any of those things. That's why that's called an exemption. You're renting a room in your own house, or if it's a 1 to 4 unit dwelling, so you have a duplex and you're renting out the other side, this applies to that as well. It is not a violation to refuse to rent a room or a unit in your own property, owner occupied. It is also an exemption if you are selling your house without the use of a broker. So if you are selling your house for sale by owner per se, you don't have to show it to every sex, race, color, religion. It's an exemption from the Fair Housing Act. So again, if you're selling your house, it's not going to go on the MLS. You're selling it yourself for sale by owner. That's an exemption. You don't have to show it to every race, color, sex, religion. It's not protected. Also, a couple of other exemptions: organizations and private clubs. They can be discriminatory. For example, maybe it's the senior citizen complex. Well, they can be discriminatory and not rent it, a unit in that complex, to someone that's not a senior citizen, to a 21 or 22-year-old, because it's a senior citizen complex. What if it's a sorority? It's the Phi Theta Kappa sorority, where they can be discriminatory and not let other individuals from other sororities actually house in those particular operations. So these are cases where a person can be exempt from following the rules under the Fair Housing Act. If you're renting a room in your own house, if you're selling your house without the use of a broker, it's not going to go on the MLS, or if it's housing operated by organizations and private clubs, they have the right to be discriminatory. Those are exemptions under the Fair Housing Act. Fair Housing Act practices. So there are 3 laws that specifically come under the Fair Housing Act, and you need to make sure that you know them. Those are block busting, steering, and redlining. Block busting, steering, and redlining are all discriminatory practices that come under the Fair Housing Act. So let's talk a little bit about each. The first one that I'm going to discuss is block busting. Another word for block busting is panic selling. Trying to induce an owner to sell their home by suggesting that the ethnic or racial composition of the neighborhood is changing, with the implication that the property values are going to go down. Trying to get someone to sell their house by saying that because another race is moving into the neighborhood, another ethnicity, now your values are going to go down. You might want to sell. That's why it's also called panic selling. Didn't you notice there was a black, a Latino, a Asian, whatever other type of ethnicity just moved in your neighborhood? Here's my card. Your values are probably going to go down. You might want to think about selling. That's something that real estate agents used to do. Try to panic people into selling by implying that because another ethnicity is moving in the neighborhood, their values are going to go down. Steering is just the opposite of that. Trying to get someone to purchase in a particular neighborhood, basing it on their race, religion, or ethnicity. So it's the opposite, trying to get them to purchase in a particular neighborhood based on their race, religion, or ethnicity. So I noticed that you are Muslim. We better find you a good Muslim community. Or I noticed that you are Latino. Let's go to a Latino community. You are Armenian. We might want to look in Glendale because that's a great community for Armenians. You can't do that. You can't say that. You cannot steer a person to a particular neighborhood based on their race, religion, or ethnicity. Now, they can steer themselves. For example, my sister-in-law is Filipino. I'm African American. My brother's African American. She's Filipino. But she said, when we got ready to look for a house, I only want to live in La Palma, California, which happens to be a highly Filipino community. And she specifically said, I only want to live in La Palma, California. There's a lot of Filipinos in in La Palma. I can go to the store. I'll feel comfortable. I'll be able to meet people. I only want to go to La Palma. She steered herself. Sometimes you'll get clients that will want you to show them a particular neighborhood that's primarily this race or primarily this ethnicity. They can do that. They can steer themselves. You just can't steer them. You can't look at a person and say, so I see that you are Catholic. Let me show you this community. I see that you are, Muslim. I see that you are Chinese. Let me show you Chinese. You can't do that. That will be steering. And then redlining, discriminatory practice under the Fair Housing Act, refusing to make loans in a particular neighborhood based on discriminatory reasons. This is something that lenders used to do, and some still do, refusing to make loans in a particular neighborhood, but basing that on discriminatory reasons. That's the reason why we have HMDA, because of redlining. What lenders used to do, and I'm not really sure how they do it now, it's a little bit more subtle, but they used to take a map and put it on the wall, and they would draw a red line through certain neighborhoods, and they would tell their clients, or they would tell their employers, not to lend in these particular areas. We're redlining those and it would be a discriminatory reason, because these people are poor, because these people are Latino, or because these people are whatever the case may be. Redlining is refusing to make loans on a property located in a particular neighborhood based on discriminatory reasons. Make sure you clearly understand the difference between block busting, trying to get them to sell their house because of discrimination, steering, trying to get them to buy in a particular neighborhood, or redlining, refusing to make loans in a particular neighborhood. Now, all of these are discriminatory practices, but you need to know who commits which. Blockbusting and steering are committed by real estate agents. The discriminatory practice of blockbusting and steering is committed by real estate agents. Redlining, that will be committed by a lender, because redlining is making loans. Well, who makes loans? Lenders. Blockbusting and steering committed by real estate agents. Redlining is a discriminatory practice committed by lenders. Redlining, refusing to make loans for discriminatory reason. All of these are practices under the Fair Housing Act. This logo you see here is the Fair Housing logo. Do not get it mixed up with ECOA. It's not required because of ECOA. It's required because of fair housing. It's called the Equal Housing Opportunity logo, and it must be on all advertising to show that that particular property and the particular real estate agents that are dealing with that particular property are equal opportunity. A person has up to 1 year to file a complaint under the Fair Housing Act. FACRA overview. Now, FACRA stands for the Fair Credit Reporting Act. And I'm going to give you a general overview of what the FACRA rule is all about. Again, FACRA stands for the Fair Credit Reporting Act. And FACRA is Regulation V. FACRA deals with credit reports. So to remember that FACRA is Regulation V, just remember you want to have a very good credit report. Do not confuse it with ECOA. ECOA is about a credit application. FACRA, F-C-R-A, is about a credit report. It was enacted by the FTC to ensure accuracy, fairness, and privacy of consumers' personal information used by the credit reporting agencies. They call the credit reporting agencies CRAs. And you know them. They're Equifax, TransUnion, and Experian. Those are the 3 credit reporting agencies. FACRA requires credit reporting agencies to verify information that's under dispute and to also limit how long negative information can stay on a credit report. FACRA provides the following 5 rights for individuals. The right for an adverse action notice. That's simply a denial letter. FACRA says you have the right to get a denial letter in writing. They can't just call and say, yeah, we'll take a look at it. No, we don't think it's going to work. That's not sufficient. FACRA says that they have to give you an adverse action notice, a denial letter, and it should be in writing. Also, a copy of your credit file. Sometimes they call it a credit file, or sometimes they call it a credit report. FACRA is the law that says that you have a right to receive a copy of your credit report. It also says you have the right to request a copy of your score. Now, the score is not free. You have the right to request a copy of your credit score, but the score is not necessarily free. And the main thing that FACRA is all about is it gives consumers the right to dispute negative and inaccurate information on their credit report. If you get a copy of your credit report and you see that something is not right, that wasn't you weren't late, then you have the right to dispute it under FACRA. And lastly, the right to limit pre-screened offers. Pre-screened offers are those offers that you get in the mail that says, hey, you've been pre-approved for $5,000, or you've been approved for a car, or whatever the case may be. And then sometimes when you apply, they say, never mind, we looked at your credit, you don't really qualify. Those are really applications to apply. You've been pre-qualified to apply for those items, not necessarily pre-qualified to receive those items. So as I said, these are the 5 rights under FACRA, and each of them will be explained in more detail shortly. Adverse action notice. Like I said before, that's simply a denial notice. You must be told if the information in your credit file has been used against you. So if you complete an application and you were denied, the entity that denied you, if they use information in your credit report, they have to give you the name, address, and phone number
of the credit reporting agency that they use to make that decision. For example, they'll say something like, we denied you. We used Equifax. Here's their name, address, and phone number. That way you can contact Equifax and see what's in your report that could have gotten you denied. A copy of your credit file. Remember I told you you have a right to receive a copy of your credit file. Under FACRA, you can receive a free copy of your credit file under one of the following reasons. One, a person has taken an adverse action notice against you, meaning you got a denial letter. If you received a denial letter, you can get a free copy of your credit report under FACRA. Two, you've been the victim of identity theft. So if you've been a victim of identity theft, under FACRA, you can receive a free copy of your credit report. Three, your file contains incomplete or inaccurate information as a result of fraud. If that's your situation, then you are entitled to a free copy of your credit report under FACRA. Or you are on public assistance. If you are on public assistance, and in this case, financial world, public assistance means Social Security, disability, child support, alimony. If any of those is your situation, any non-taxable income, you can receive a copy of your credit report for free. And 5, if you are unemployed and expect to apply for employment within the next 60 days, under FACRA, you can receive a free copy of your credit report. So these are the reasons why you can get a free copy of your credit report under FACRA. If one of these are not your situation, you can't get a free copy of your credit report under FACRA. Maybe there's another law, and we're going to discuss another one shortly, that you can use, but these are the reasons that would allow you to get a free copy of your credit report under FACRA. I'm not saying that you can't get a free copy of your credit report. You just have to find another law that's not FACRA to get a free copy of your credit report. And we're going to discuss one again in just a few minutes that you can use it just for that purpose. Now your credit score. You have a right to ask for your credit score. Now the credit score is not necessarily free. There is no law that says that they have to give you a free copy of your credit score. Many of the companies charge for the credit score. So you may request a credit score from one of the consumer reporting agencies, and they may require that you pay for it. Remember, the credit report is free. The credit score is not free. Disputes. You have a right to dispute incomplete or inaccurate information on your credit report. Like I said before, you take a look at your report, you see that something is not wrong, it's incorrect, it's incomplete, they have to remove it. Consumer reporting agencies must correct or delete any inaccurate, incomplete, or any information that they can't verify from your credit report. You can file a dispute. They have 30 days to try to prove it. The burden of proof is on the credit reporting agency. If they cannot confirm it, then they have to remove it. Pre-screened offers. Those are those pre-screened offers. They normally come from credit companies or insurance companies. You get these pre-approved offers, and then they prompt you to have your credit pulled. If you want to be taken off the list of pre-screened offers or to be able to receive pre-screened offers, you can write your credit reporting bureaus. You have to write all 3, and you have to let them know that according to FACRA, you don't want to be on a list of individuals to receive pre-screened offers, to take you off that list. And even when they give you these notices, most of them are in the mail, they have to have a number at the bottom and some information where you can write to let you know who to contact and where to contact, or where to log on to the internet to be taken off the list to receive pre-screened offers. Other provisions under FACRA: individuals that are pulling someone's credit report, even you as a loan officer, you must have a legitimate business need. You can't just pull someone's credit because you want to know a little bit about them. You have to have a legitimate business need. Maybe they're applying for insurance with you, applying for an auto loan with you, something of that nature, but you just can't go around pulling people's credit report. You also cannot pull your employee's credit report without their written consent. Just because they work for you doesn't mean that you have the right to pull their credit report anytime that you want. You have to have your employee's written consent to be able to pull their credit report, or you're in violation of FACRA.
Under FACRA, credit reporting agencies may not report outdated negative information. So, negative information must be removed after 7 years. So any negative information on your credit report, it must be removed after 7 years. Late payments, things of that nature. Bankruptcies, they can't stay on your credit report for more than 10 years. So it doesn't matter whether it's a Chapter 7 or Chapter 13 or whatever chapter, the longest that a bankruptcy can stay on your credit report is 10 years, and then they have to remove it. Now, some states put criminal convictions on your credit report. They do a lot of this in the East Coast. If you're in one of those states and they put a criminal conviction on your credit report, it's usually like Ponzi schemes or money laundering or things of that nature. It stays on there forever. Criminal convictions do not come off. Another thing is not listed here, but I want you guys to pay attention to it. They'll try to trick you. Tax liens. So listen to me. Unpaid tax liens will stay on your credit report forever. Unpaid tax liens. But paid tax liens will stay on your credit report for 7 years. And after 7 years, they have to remove it. So unpaid tax liens will stay on your credit report forever. They don't expire. A lot of times people think if they just wait out the 7 years that the tax lien will go away. Not tax liens. Unpaid tax liens will stay on your credit report forever. Paid tax liens, once they're paid, then they do their 7 years and then they can be removed. So now I want to talk about the FACT Act, the Fair and Accurate Credit Transaction Act. Sometimes we refer to it as FACT Act, other times it's referred to as FACTA. And the biggest thing that this act discusses is identity theft. In 2003, Congress added additional provisions to the Fair and Accurate Reporting Act, to FACRA, the law we just discussed. In 2003, they added the FACT Act under FACRA. So the FACT Act became a part of FACRA. The FACT Act was designed to address the problems of identity theft and make it easier for consumers to access his or her credit report. So 2 things, among others, that you'll learn, but the 2 main things is to address identity theft, but also to make it easier for consumers to have access to their credit reports. According to official government estimates, as many as 12 million Americans have had their identity stolen each year. So the FACT Act was put in place to help with the following: identity theft prevention and credit history restoration, to improve the use of consumer access to credit reporting information, enhancing the accuracy of consumer reporting information, and to limit the use of sharing of medical information. So, issuing free credit reports. Before the passing of FACTA, a consumer had to pay to receive a copy of his or her credit report. Now, under FACT Act, you can get a free copy of your credit report from each of the credit reporting industries once a year. They can't charge you for it. In order to encourage consumers to self-monitor their credit report as a means of detecting identity theft, Congress requires that each of the 3 national credit bureaus, Equifax, TransUnion, Experian, provide a free credit report annually when requested by the customer. You don't want to go 3 years, 4 years, 5 years and learn that someone's been using your identity and you don't want to have to pay for a credit report to find out this information. So in order to encourage consumers to self-monitor their credit reports as a means of detecting identity theft, Congress requires that each of the 3 credit reporting bureaus provide a free copy annually to the consumer, but you have to request it. They're not going to just automatically send it to you. As it relates to disclosing credit scores, they don't have to give you your credit score for free. They can charge you for your credit score, but they can't charge you for your report. Consumers have a right to purchase a copy of their credit score. Again, the credit reporting agency does not have to give you your score for free, but they do have to give you your report for free. The FTC recommends using www.annualcreditreport.com for the purposes of obtaining your free credit report. That is the one that is recognized and that is recommended by the federal government. You hear about a lot of them out there. There's tons of commercials. freecreditreport.com or Credit Karma or all of those. But if you want to use the one that's actually backed by the federal government, you want to go to www.annualcreditreport.com. That is the one that is recommended by the FTC, the Federal Trade Commission. Another provision under the FACT Act, Section 216. It talks about security and disposal of clients' information. It says that we as mortgage loan originators, we have to properly secure and dispose of our clients' information. The FACT Act requires businesses to burn and shred papers that contain consumer reporting information. Destroying or erasing electronic files or media so that information cannot be recovered, or locking up pending loan files at the end of the day. Just because you're done with the person's file and maybe you got paid on that loan, you can't just throw the file in the trash. Someone can pull that information out and commit identity theft. And at the end, you're supposed to burn it or shred it. And at the end of the day, when you finish working on a file, you're not supposed to just leave it on your desk. It's supposed to be put into a locked file cabinet. What if the janitor comes in and the person's file is on the desk? They can go through all of their personal information. So whether you're leaving for lunch or leaving for the end of the day, you're supposed to lock up the information. So Section 216 of the FACT Act is about security and disposal. And it requires that businesses burn or shred papers that contain consumer report information and that you destroy any information. But more importantly, you want to make sure that you lock up any pending loan files. Don't just leave them on your desk at the end of the day. That is a direct violation of the FACT Act. You should know that any person who obtains a credit report without prior authorization or credit reporting agency employee who gives a credit report to an unauthorized person can be fined $5,000, imprisonment for up to 1 year, or both. So you cannot give a person a copy of their credit report. You can't do that. And a lot of times they'll tell you, but I paid for my credit report, especially when you're doing a mortgage for a person and they have to pay the $35 or $40 for a copy of their credit report. They feel that you should give them a copy of that credit report. But that's not the case. You cannot give them a copy of their credit report. And they'll say, but I paid for it. No, they paid for you to have access to it in order to make a decision. Again, yes, they paid, but they paid for you to have access to it to make a credit decision. You can't give them a copy of it. You can show it to them, but you can't give them a copy of it. If they want to know what's on their credit report, they're supposed to write Equifax, TransUnion, Experian, and get a copy directly from the credit reporting agencies. You cannot give it to them. And you can't pull unauthorized credit. So any person who obtains a credit report without prior authorization or a credit reporting agency employee who gives credit reports to an unauthorized person may be fined $5,000, imprisonment up to 1 year, or both. But this rule also applies to you as a mortgage loan originator. Gramm-Leach-Bliley Act, the GLBA Act. This act is also known as the Financial Modernization Act of 1999. It has to do with protecting a person's financial information. Now, the Gramm-Leach-Bliley Act was created by Senator Graham, Senator Leach, Senator Bliley, and their whole law that they created was to help protect a consumer's personal information. Issues pertaining to the Gramm-Leach-Bliley Act deal with safeguarding, pre-taxing, and financial privacy. Companies must have these policies in place if they're going to be working and dealing with consumers. The first one we're going to talk about under the Gramm-Leach-Bliley Act is the safeguarding rules. All companies must have a written security plan on how they're going to protect the confidentiality and integrity of our personal information. When you go to Olive Garden or to the airport or to any store or to any place that you use your credit card information, Target, Walmart, and you use your credit card, you should feel safe. You should feel okay with giving them your credit card because they have a security plan in place to make sure that no one's going to hack your account. Because all companies have to have what's called a written security plan on how they're going to protect our personal information. The security plan must describe the measures that the firm will take to protect the data, and employees should be trained on the requirements of the plan. These are called safeguarding policies, and the whole purpose of these policies is to ensure security and confidentiality, to protect us against threats and hazards, and to protect against the unauthorized access that can harm or inconvenience customers. Now, that's one policy under the Gramm-Leach-Bliley Act. The pre-taxing provision prohibits the use of false pretenses, including fraudulent statements and impersonation, to obtain consumers' personal financial information, such as bank balances or things of that nature. Pre-taxing is when someone pretends to be you and attempt to gain access to your information under false pretenses, or you pretending to be someone else and gaining access to their information under false pretenses. For example, say if I was trying to get into my husband's bank account online and I put the password in wrong. If I put it in wrong too many times, then it's going to block me out. And then there's going to probably be some security questions that I have to ask, like what's your mother's maiden name or your first car. Those are pre-taxing policies. Policies to prevent others from gaining access to your information under false pretenses. So a pre-taxing policy is a policy to prevent others from gaining access to your information, pretending as if they're you and gaining access to your information under false pretenses. Other policy under the Gramm-Leach-Bliley Act is the financial privacy policy. Now, what this policy does is it governs the collection of non-public information and how it's shared with affiliates. These organizations that we deal with, they share our information. That's why you get so much junk mail. That's why you get so much spam, because companies share your information. Well, this particular law governs the collection of non-public information. Non-public information is information that's widely available or known about you. Someone can Google it on you. For example, if I filled out a loan application at Chase, I'm putting some information on that application that's not public information. There's only so much they can share with their affiliates. They also have to give you what's called their consumer privacy policy. And they have to ask you if it's okay to share your information. And you have the right to opt in or opt out of having your information shared. You need to make sure that you understand a consumer is someone that may just have a one-time purchase. For example, I may go into 7-Eleven or or Walgreens or Rite Aid and make a one-time purchase, I may never go back to that location again. That's a consumer.
Do not call registry. The Do Not Call Registry Implementation Act was signed into law in 2003 as part of earlier legislation, the Telemarketing Consumer Fraud and Abuse Prevention Act and the Telemarketing Sales Rule. The law is intended to allow consumers to restrict unwanted sales from coming to their homes. It's part of the Telemarketing Consumer Fraud and Abuse Prevention Act. Today, the Federal Trade Commission, Federal Communications Commission, and the states enforce the National Do Not Call Registry. Many mortgage professionals have successfully forged new business relationships by cold calling prospects. Loan originators must exercise particular care in order to avoid violating restrictions on telemarketing. To keep from violating DNC regulations, a company must maintain both national and internal company lists of customers and prospects and keep them updated regularly. Both the national DNC list and the company's internal DNC list must be updated every 31 days, and records to document this must be maintained for 24 months. Violators could be fined up to $43,280 per call, as each call, not each day, is considered a separate incident. Telemarketing calls may only be placed between 8 a.m. and 9 p.m. in the time zone of the consumer being called. The National Do Not Call Registry does not limit calls by political organizations, charities, or telephone surveyors. DNC Safe Harbor Rule. Everybody makes mistakes, and companies won't be held liable if they have a written do not call policy, train employees on a regular basis regarding the policy, maintain an internal list of customers who requested not to be called, access the register every 31 days, documentation in error. Established Business Relationship, EBR. EBR entities may contact someone on the DNC registry provided they have an established business relationship, which can be established in one of two ways. 18 months after the consumer's last purchase or transaction, the consumer purchased, rented, or leased goods and or services from the seller, or participated in a financial transaction between the consumer and the seller within 18 months preceding a telemarketing call. 3 months after the consumer makes an inquiry or submits an application to the company preceding a telemarketing call. Regardless of the existence of an established business relationship, if a consumer specifically asks not to be called or contacted, then that request must be honored. Thank you for watching.
Protection Act talks about PMI, private mortgage insurance, and when PMI can be canceled. And people always want to tell me, no, PMI can never be canceled. Well, you're talking about MIP, mortgage insurance premium. That's not what we're on right now. That's FHA loans. I'm discussing HIPAA, the Homeowners Protection Act, HPA, and HIPAA deals with PMI, private mortgage insurance, and when PMI can be canceled. Now, the HIPAA law passed in the United States Congress and was signed by President Bill Clinton back in 1998. And the whole purpose is it's designed to help protect homeowners who have mortgages on their home, and they also have PMI, private mortgage insurance. So a couple of things I want to make sure you understand. Number one, PMI, private mortgage insurance, is something that's required on conventional loans when the borrower puts less than 20% down. When will they borrow have to pay PMI. If they're getting a conventional loan and they're putting less than 20% down, they'll have to pay an insurance premium called PMI. PMI is on conventional loans, not government loans. Government loans are FHA, VA, USDA. We're not on those yet. So PMI and HIPAA deal with conventional loans, not government loans. Also, PMI protects the lender, not the borrower. So a borrower can request cancellation of PMI when the loan balance reaches 80% LTV, 80% of the value of the original value, purchase price, or the appraised value, whichever is less. When can a borrower request cancellation of PMI? When the loan reaches 80% of its original value. So either it's been paid down by 20% or it appreciated by 20%. The point is, when can the borrower request it? When the loan has 80% loan to value left. Only applies if the loan amount is current and the payment history is acceptable. That's why the borrower can request it. The lender does not have to do it. But if the borrower requests it and they meet these qualifications, it's current, they have a decent payment history, as indicated here, the lender might approve removing their PMI. But once the loan reaches 78% LTV, 78% meaning it's been paid down by 22%, because they pay it down by 22%, how much is left? 78. But at 78%, the lender must cancel the PMI. Now it says here automatically. That's the term that they like for us to use. But I'm kind of use that word loosely because automatically disappear. You're going to have to watch that and you're going to have to be proactive. But the point that I want to make is, at what point can the borrower request cancellation of PMI? At 80%. At what point must the lender remove the PMI? At 78% LTV. If we're at 78% LTV, they must remove the PMI. The lender must also provide a disclosure to the homeowner at the closing, letting them know their rights about cancellation. In addition, they have to send them a notice every year, letting them know their right about possibly canceling the PMI. And if the PMI has not been canceled or terminated and the loan reaches its midpoint, they have to cancel it at that point as well. That means if you have a 30-year loan and now you're at 15 years, even if you're not at the 78 or the 80%, they have to cancel the PMI. So this is what I want you to take away from this. When can the borrower request cancellation of PMI? When the loan reaches 80% of its value, 80% LTV. Either they paid it down by 20% or maybe they got equity in it. Maybe it appreciated by 20%. The point is, when can the borrower request at 80%? And then the next point is, when must the lender remove the PMI? They don't have a choice. They may order an appraisal or do some other BPOs or things of that nature, checking out the value. But if it's determined that the loan is at 78% or less of the original value or appraised price, then they must remove the PMI. Community Reinvestment Act. Let's discuss this federal law, the Community Reinvestment Act. The Community Reinvestment Act was actually enacted by Congress in the early 1977. It's been updated a few times, but the primary purpose of this law is intended to encourage depository institutions to help meet the credit needs of the communities in which they operate. So again, the purpose of the law is to push depository institutions, banks and savings and loan companies to meet the credit needs of the communities in which they operate. What was going on is that you have banks. They were popping on almost every corner in every neighborhood, but they would not give loans to the individuals in those particular neighborhoods. They would take their money for checking and savings account, but when it came time to give them a mortgage, a loan, an auto loan, a line of credit, they would give them credit. They would say the people in this community don't qualify for credit with us. And what the CFPB decided to do in Congress, they said that if you're going to be in these communities, you have to help meet the credit needs of the people in the community. You just can't use their money for checking and savings account. And if for some reason they don't qualify for a mortgage loan, an auto loan, or a line of credit, what are you doing to kind of help them? Are there any homeowner seminars? Are there any credit repair seminars? Are there any workshops to kind of help the people in the community? The whole purpose of this law is if these banks and institutions are going to be in the various communities, they have to, in some kind of way, give back to help meet the credit needs of the community. Now, I don't want you to get this mixed up with HMDA. The purpose of HMDA is to help meet the housing needs of the community. This is the Community Reinvestment Act. The purpose of this law is to help meet the credit needs of the communities. So keep that right. HMDA deals with the housing needs, but the Community Reinvestment Act deals with the credit needs of the community. HMDA is the Home Mortgage Disclosure Act, and HMDA is Regulation C. The whole purpose of HMDA is to help meet the housing needs of the communities in which they operate. We talked about the Community Reinvestment Act, and it's designed to help meet the credit needs of the communities, but HMDA is designed to meet the housing needs in the communities in which they operate.
HMDA was written in response to the public concerns regarding redlining. This information is collected in Section 8 of the 1003, Uniform Residential Loan Application. If refused and the application is being taken face-to-face, interviewer is required to make a visual observation, or otherwise, HMDA requires the lender to complete the report based on surname. Reg C requires a lender to file Loan Application Register, LAR reports due March 1st of each year. LAR reports contain information regarding the ethnicity, race, and sex of individuals that apply for a loan. HMDA information Reg C is now Section 8 and is referred to as the demographic information. The purpose is in identifying possible discriminatory lending patterns through the collection and the disclosure of data about applicant and borrower characteristics.
MARS stands for the Mortgage Assistance Relief Service. It's Regulation O, and the whole purpose of MARS is to help protect distressed homeowners against foreclosure scams. More specifically, it deals with loan mod and loan mod scams. MARS is regulated by the FTC, the Federal Trade Commission, and what was going on is that in the past, a lot of people that were seeking loan modification help, they were scammed. They paid a lot of money up front. They didn't get a loan modification, or the attorneys took a lot of money from them. There was a whole bunch of individual loan modifications popping up saying that they can help you modify your home, and they really didn't do anything. So this is what this law says. Number one, fees may not be collected until a written agreement from the lender that the loan terms have been modified, have been delivered, and the borrower accepts the modification. Some companies got people modifications, but the consumer didn't accept the modification. Well, they weren't supposed to be paid on that particular modification. You can only get paid on a loan modification nowadays if, number one, you can't take any money up front. You can only get paid at the end if the modification is approved and if the borrower accepts the loan modification. That's the only thing. So MARS prevents upfront fees or advanced fees as it relates to foreclosure scams, loan mod scams, short sale scams, any type of foreclosure relief scam. Also, the negotiator cannot advise the borrower to stop making mortgage payments. A lot of people that got loan mods, they were told that the only way that they can get it is if they stop making their payments to the mortgage company. And that was unethical for them to tell them that, because then people stopped making their payments. Not just one payment, not just two payments. We did loan modifications and I had borrowers that hadn't made 18 payments because someone told them that the only way that they were going to qualify is if they didn't make their payment. So a negotiator, MARS, prohibits the negotiator from telling the borrower to not make your payment. Because if you don't make one payment, you don't make two payments, maybe in your loan mod doesn't get approved, maybe you can catch up from that. But what if you didn't make payments for a year and then your loan mod got denied? That's a lot of money to have to come up with to save your house. So again, negotiator cannot advise the borrower to stop making mortgage payments. And lastly, the negotiator cannot interfere with communication between the borrower and the lender. What this means is there were a lot of negotiators, especially agents, telling the borrower, don't answer the phone when your lender calls. You don't have to take their calls. You don't have to communicate with them because that's what we're doing for you. And in essence, a lot of loan modification companies did not properly communicate with the bank. They told the borrower not to talk to the bank, and then they didn't talk to the bank, so no one talked to the bank, and the house got foreclosed on. So Mars says, no, it's a violation. You cannot tell them not to speak with their lender. So these are the three things that are prohibited under Regulation O, under Mars. No upfront or advance fees. Don't tell them to stop making their payment. Don't tell them that they should not communicate with their lender.
So the eSign Act. The eSign Act is the Electronic Signatures in Global and National Commerce Act, otherwise known as the eSign Act. And the whole purpose of this law, it was passed to address the validity of electronic signatures. So what this law says is that electronic signatures are valid, but it also says that you cannot force someone to do electronic signatures. If someone still wants to do wet signatures, meaning they actually want to sign with an ink pen on their documents, that's their right. What was going on is that you had hotshot loan originators saying, we're going to email you the documents and you need to e-sign them. And sometimes people didn't understand it. They were elderly, they didn't have computers, English wasn't their first language, or they didn't want to e-sign. They wanted to actually see the papers in their hand and sign them that way. And that was their right. So in general, the law clarifies that a contract or signature cannot be considered invalid just because it's in electronic format, but it does say that a borrower has the option as to whether or not they want to sign that way. In order for the required document to be sent to the consumer only in electronic format, they must first obtain that consumer's consent. That's the eSign Act. MAP, Mortgage Acts and Practices. It's also known as Regulation N, and it's about commercial advertising. We talked about advertising in TILA, but that's a little different. This is commercial advertising, meaning it's on TV, it's on radio, it's on a podcast, some type of social media, things of that nature. That's where MAP comes in. And Regulation N was issued to prohibit false and misleading advertising in commercial advertising of mortgage products. It says that advertising for mortgage products and services cannot obtain material misrepresentation, whether they are stated or implied. And the fact is material if the knowledge of that would lead the consumer to an alternative decision, meaning you can't hold a secret back. You can't hold something back. You have to give all the information. Sometimes you would have loan originators that will hold back information because they felt that if the potential borrower knew about it, they might make a different decision. Well, that you can't do. If it's a material fact, something they should know, you should put everything on the table. And it also says that copies of all advertisements must be kept for 2 years. So if it's a radio script, if it's a commercial, they're supposed to hold on it from 2 years from the time that it was actually used. As it relates to this part about fixed, they don't want us under MAP to lead with the word fixed. They think that that's misleading. Some people said that they didn't know that their loan was adjustable because it said it was fixed. But in fact, it was fixed for 2 years, then it adjusts. Or fixed for 3 years, then it adjusts. If you're going to use the word fixed, it has to be fixed for the entire term of the loan. And that's what MAP is about. The USA Patriot Act, the whole purpose of the Patriot Act was intended to respond to terrorism and to monitor suspicious activity. It came about because of 9/11. That's when this Patriot Act was actually established. And it sets minimum standards for verifying customers' identity. The Patriot Act says that lenders must verify name, address, social security, and date of birth of all applicants. It also requires all financial institutions to establish what's called anti-money laundering programs. And the whole purpose of those are to help identify and address financial crimes. The Bank Secrecy Act, also called the Anti-Money Laundering Act, requires financial institutions to have policies to detect money laundering and suspicious activity. The act requires financial institutions to keep track of records of all cash transactions exceeding $10,000. So anytime you're withdrawing, depositing, or transporting cash of $10,000 or more, the financial institution, the bank, must keep track of that. It also requires that loan originators report suspicious activity. We must file a suspicious activity report on anything that we feel is suspicious, like signs of tax evasion, money laundering, or criminal activity. But that's at the point of $5,000. MLOs are required to report any suspicious activity to the FBI via a suspicious activity report of anything exceeding $5,000. These suspicious activity reports must be filed no later than 30 days after the date of the initial detection of the issue. A bank must maintain a copy of a suspicious activity report and all supporting documentation from 5 years from the date of signing.